Welcome to the Deep Dive, where we unpack complex topics. Think about any business. Is its journey ever just straight up? Constant profits? Rarely, right? Businesses have incredible highs, but also some really challenging lows, good years, bad years, just how commerce works. But how does the tax system, our intricate tax system, actually handle these ups and downs? How does it keep things fair for a company that hits a rough patch? Especially if they're investing heavily, maybe trying to grow. And that brings us right to our topic today. Net operating loss, or NOL, specifically for corporations. It sounds technical, and, well, it can be, but it's fundamental. Our mission here is to demystify the NOL. What is it? Why does it matter so much? How do you calculate it? And importantly, how have the rules changed? Think of this as your shortcut to getting a handle on this vital tax concept. Before we dive deeper, a quick reminder that this podcast is based on material from Farhat lectures. All content, examples, and explanations discussed here are derived from the comprehensive accounting resources at farhatlectures.com.
Whether you're an accounting student, CPA candidate, or professional, visit the website for additional practice questions, video lectures, and detailed support to reinforce today's topic. Special thanks to Professor Farhat for providing this valuable material. Okay, so let's unpack this NOL thing. How does the tax system even define a loss for a corporation in a way that really matters? What is a net operating loss, basically?
Right. At its core, an NOL arises in a tax year when a corporation's deductions are actually greater than its income. Simple as that, really. You spent more than you earned, tax-wise. It's a loss.
Okay, expenses exceed income. Makes sense. But why have a special rule for it? Why not just say, tough luck, bad year?
Well, it boils down to fairness, fundamentally, and recognizing that a business isn't just 12 months, then another 12 months. It's continuous. Let's imagine two companies, Adam Corp and Avis Corp. Over 5 years, Avis Corp is steady, makes $12,000 profit every single year. So after 5 years, that's $60,000 total net income. Pretty straightforward.
Okay.
Adam Corp, though, is cyclical. Big swings. Maybe $20,000 income one year, then a massive $160,000 loss the next, then $170,000 income, another $120,000 loss, then finally $150,000 income. Now, if you add all that up for Adam Corp, the ups and the downs over the 5 years.
Let me guess. $60,000.
Exactly. Same total net income as Avis Corp, $60,000. But here's the kicker. If we didn't have NOL rules, think about the taxes. Avis Corp, nice and stable, might pay, say, $12,600 in taxes over the 5 years, assuming a 21% rate, for example.
Right.
Adam Corp. Without NOLs to offset those loss years against the profit years, they'd be looking at a tax bill of, wait for it, $71,400.
Wow, that's hugely different for the same overall profit.
Hugely different and profoundly unfair, right? Congress saw that. They realized, businesses investing in R&D or just in naturally cyclical industries shouldn't get hammered just because their profits aren't perfectly smooth. The idea is to let them average things out tax-wise, treat the business as a continuing entity.
That fairness argument is powerful.
Yeah.
But I bet it adds layers of complexity, too. For businesses trying to use these rules, what are the pitfalls? And practically, where does this NOL deduction actually show up on their tax return?
Oh, absolutely. You need to navigate it carefully. The deduction itself, once you've calculated it and are ready to use it, appears right on Form 1120. That's the main corporate tax return. You'll find it on line 21A. Clearly labeled net operating loss deduction. It directly reduces taxable income for that year.
Okay. Line 21A on the 1120. Got it.
Now, calculating the NOL in the first place, that's where you need to pay close attention to some specific rules. These aren't just minor points. They can really change the outcome. First, big one. No double dipping.
Makes sense.
Yeah. An NOL carry forward from a prior year cannot be used when you're figuring out the NOL for the current year. You can't use an old loss to generate a new loss.
Okay, keep prior NOLs separate when calculating the current one. What's next?
Second, and this one's a bit tricky, the dividend received deduction, or DRD, limitation. So corporations get a deduction for dividends they receive from other corporations, right, to avoid triple taxation.
Right, the DR.
Normally, there's a limit on how much DRD you can take, often tied to your taxable income. But, and this is the crucial exception, that limit is ignored, completely disregarded, if taking the full DRD actually creates an NOL or makes an existing NOL bigger.
Whoa, okay, so if you're near or in a loss, the DRD limit might just vanish.
Exactly.
Right.
It's a powerful boost in loss situations. Third point, charitable contributions. Simple one here. You calculate your NOL before you deduct any charitable contributions. You can't use your charitable giving to push yourself into an NOL, basically.
Got it. Contributions come after the NOL calculation.
And finally, number 4, capital loss carryovers. This is different from an NOL carryover. If you have a capital loss carried forward from a previous year, you can deduct that against capital gains in the current year when figuring out the current year's NOL.
So capital loss carryovers do factor into the current NOL calculation, unlike NOL carryovers.
Precisely.
Yeah.
It's an important distinction.
Okay, these rules, especially that DRD one, sound like they could interact in interesting ways. Maybe walking through an example would help solidify this. Let's take Mike's situation you mentioned.
Good idea. Let's look at Mike's corporation for the current year. Gross income, $250,000. And importantly, that includes a $45,000 capital gain, dividend income, $60,000 from XYZ Corp, where Mike owns 50%. Operating loss for the year, $260,000. Ouch. And he has a $20,000 capital loss carried forward from a prior year.
Okay, quite a mix there. Profit elements, loss elements, dividends, carryovers.
Yeah.
How do we calculate the NOL?
We follow the rules. Step 1, capital loss offset, that $20,000 capital loss carry forward. We use it immediately against the $45,000 capital gain.
Okay, so that reduces the capital gain down to $25,000 net.
Correct. Net capital gain is now $25,000. Step 2, dividend received deduction. Mike owns 50% of XYZ, so he gets a 65% DRD on those $60,000 dividends. 65% of $60,000 is $39,000.
Okay, $39,000 potential DRD. Now, how does that limitation rule play in?
This is the key part. We tentatively calculate Mike's taxable income before the DRD. So $250,000 gross income, including the now $25,000 net capital gain, minus the $260,000 dividend loss, plus the $60,000 dividend income. Without the DRD yet, he's actually slightly positive. But if we subtract the full $39,000 DRD...
It pushes him into a loss.
Exactly. Taking the full $39,000 DRD creates an NOL. And because it creates the NOL, rule number 2 kicks in. Disregard the taxable income limitation. Mike gets the full $39,000 DRD.
That's the aha moment for the calculation.
It really is. So let's put it all together. $250,000 gross income minus $260,000 DRD. We end up with a net operating loss for Mike of $17,000. That $17,000 is his NOL for the year. The DRD rule was critical there.
That example really clarifies how that DRD rule works in practice. It's quite beneficial in loss scenarios. Now, you mentioned earlier that these NOL rules haven't always been the same. They've actually changed quite a bit, haven't they?
Oh, significantly. It's crucial to know when the loss happened. The year the NOL arose dictates the rules you play by. Think of them as different vintages of NOLs, each with its own set of carryback and carry-forward rules and deduction limits.
Okay, so let's break down these vintages. What were the rules for, say, older losses?
Right. For NOLs arising on or before December 31st, 2017, so 2017 and earlier, these losses could be carried back 2 years. So you could go back, amend old returns, maybe get a refund, and they could be carried forward for 20 years. Crucially, when you use them, they could offset 100% of your taxable income before the NOL deduction. So you could potentially wipe out your tax liability completely in a profitable year using these older NOLs.
2 years back, 20 years forward, 100% offset.
Yeah.
Got it. What changed after 2017?
Then came the period after December 31st, 2017, specifically for NOLs from 2018, 2019, and 2020. This was a temporary shift, partly due to economic conditions and legislation like the CARES Act. The carryback period was actually extended to 5 years.
5 years back. Wow.
Yes, a much longer look back. And the carry forward became indefinite, no more 20-year limit, which is huge. And importantly, the deduction limit remained at 100% of taxable income for these years. So still potentially zeroing out income.
Okay, 2018, 2020, 5 back, indefinite forward, 100% offset. What about now? Losses arising recently.
This is the current regime. For NOLs arising after 2020, so 2021 onwards, big changes here. First, no carryback allowed. 0. You can only carry these losses forward.
I don't carry back at all. Okay.
It's still carry forward indefinitely, which is good. But, and this is the major shift, the deduction is now limited.
Yeah.
You can only offset 80% of your taxable income before the NOL deduction with these newer NOLs.
Only 80%. So even if you have a massive NOL from 2021 or later, you'll still pay some tax if you have income.
Precisely. You can reduce your taxable income significantly, but you can't eliminate it entirely using these post-2020 NOLs. There will always be at least 20% of your income base subject to tax. That's a fundamental strategic shift for businesses.
Definitely changes the planning aspect.
One last point on carrybacks when they were an option. So for those pre-2021 NOL, the company could choose. They could elect not to carry back and just carry forward. But if they did carry back, they had to go to the earliest eligible year first. Like for a 2017 loss with a 2-year carryback, you'd hit 2015 first, then 2016.
Wow. Okay. So you could have a company today dealing with maybe a 2017 NOL remnant, a 2019 NOL, and a 2022 NOL, all subject to different rules. That sounds complex to manage.
It certainly requires careful tracking. A NRL schedule is essential.
How does that play out? Let's use that Adam Inc. example again. They had income and losses across these different rule periods. How would they apply everything?
Okay, let's map it out for Adam Inc. Remember their history started in 2016. 2016, $30,000 income. 2017, $60,000 loss, NOL. 2018, $32,000 loss, NOL. 2019, $42,000 income. 2020, $5,000 income. 2021, $10,000 income.
Right. So they have a 2017 loss and a 2018 loss to use.
Exactly. Let's start with the 2017 loss of $60,000 rule. Pre-2018 NOL, so 2-year carryback, 20-year carry forward, 100% offset, carry back 2 years. The only prior year with income is 2016, $30,000. So we use $30,000 of the 2017 NOL to wipe out that 2016 income. Adam Inc. gets a refund for 2016 tax paid. Remaining 2017 NOL, $60,000 minus $30,000 is $30,000. This carries forward for 20 years.
Okay, $30K from 2017 left, carried forward. Now the 2018 loss.
The 2018 loss of $32,000 rule. 2018-2020 NOL, so 5-year carryback, indefinite carry forward, 100% offset until used after 2020. Can it carry back 5 years? Well, 2017 was a loss. 2016 income is already gone. No prior income left, so no carryback is possible here. The full $32,000 from 2018 carries forward indefinitely.
Got it. So now we hit 2019 with $42,000 income, and we have 2 NOLs available, $30K from 2017 and $32K from 2018. Which one first?
Good question. You generally use the oldest NOL first, the one that might expire sooner. The 2017 NOL has that 20-year limit, while the 2018 NOL is indefinite. So use the $30,000 NOL from 2017 first, apply it against the $42,000 income in 2019. Since it's a pre-2021 NOL being used in 2019, the 100% offset applies. Income remaining in 2019, $42,000 minus $30,000, $12,000.
Okay, $12K income left. Now use the 2018 NOL.
Yep. Use $12,000 from the $32,000 in 2018 to offset that remaining income. Again, it's a 2018 NOL used in 2019, so 100% offset is allowed. 2019 taxable income, 0. Remaining NOL from 2018, $32,000 minus $12,000 till $20,000. This carries forward.
Makes sense. Next year, 2020, only $5,000 income.
Right. In 2020, $5,000 income, we still have that $20,000 from 2018. Use $5,000. It's a 2018 NOL used in 2020, so the 100% offset still applies. 2020 taxable income, 0. Remaining NOL from 2018, $20,000 minus $5,000, $15,000. Carries forward.
Okay, still straightforward. But now we hit 2021. This is where the new rule kicks in, right?
This is the critical point. In 2021, Adam Inc. has $10,000 income. We have $15,000 NOL remaining from 2018. However, we are now using this NOL in a tax year after 2020, so the 80% limitation applies.
So they can't use $10,000 of the NOL.
Correct. They can only use the NOL to offset 80% of their $10,000 income. 80% of $10,000 is $8,000. So only $8,000 of that $15,000 NOL from 2018 can be deducted in 2021.
Leaving them with taxable income.
Yes. 2021 taxable income. $10,000 income minus $8,000 NOL deduction equals $2,000. They have to pay tax on $2,000. And the remaining NOL from 2018 is now $15,000 minus $8,000 under $7,000. This $7,000 carries forward indefinitely.
But will always be subject to that 80% limit in future years under current rules.
Exactly. That 80% limit sticks with it now.
So tracking these NOLs, their origins, their usage, it's clearly crucial. But ultimately, once calculated and applied correctly, it just functions as a regular deduction on the tax return, right? Like we said, line 21.
Precisely. In the end, it acts like a standard business deduction, reducing taxable income. But the journey to get that number right, especially with the changing rules, requires real diligence. These NOL provisions, though complex, are absolutely vital. They provide essential flexibility, acting as a financial shock absorber for corporations, navigating the natural ebbs and flows of business, investment cycles, R&D. It really comes back to that core idea of fairness and business continuity.
What strikes me, thinking about all this, is how those changing rules, especially that 80% limitation going forward, might really shift how companies think long term. You know, how might businesses now strategically manage their big investments, maybe even structure their operations differently, knowing that the tax shield from future losses isn't quite as complete as it used to be? How does that 80% factor change the equation? That's definitely something interesting to consider. We've certainly unpacked a lot today on net operating losses, from the why and the what to the how to calculate and those all-important rule changes over time. To really make this stick, practice is key. We strongly encourage you to continue your own deep dive. Head over to farhatlectures.com. You'll find MCQs, true-false questions, detailed videos, tons of resources to reinforce what we've covered. Really invaluable whether you're prepping for the CPA exam or tackling your accounting courses. Until next time, keep diving deep.